We've had one of the worst weeks in the S&P for quite some time, with many companies, especially the Mag 7, deep into the red, and Google is no different, down 5%. When we take a look over the last month, we do see a slightly different story. However, with Alphabet, we get the same continuation of a downtrend, more than 12%. And no surprises that given some of the recent events in the overall market and economy, we are sitting in extreme fear, with many investors scared about the overall future, but we are still seeing a lot of companies right across the board trading at some rich valuations. However, one company that doesn't apply to right now is Alphabet, based on this trading around a 17 on a forward valuation. On others, we do get to a slightly different figure, but we want to understand right now Alphabet, which is now trading in the midpoint of the 52-week range, down year to date as well, around 10%. Is this company a buy, severely undervalued, or is this actually a value trap, one that we should significantly avoid? And we're going to get to our conclusion by the end of the episode, also running it through our own valuation model. And we can see over the last 10 years, they have massively outperformed the S&P, up 497%. Now, both Wall Street and Seeking Alpha consider this company to be a buy, and Wall Street's 4.4 is not far off the 4.5 to flip this into a strong buy rating. And we want to start the episode off by looking at super investors, as when we get a glance at their overall portfolio, it is very telling about what they see in terms of undervaluation across companies. And one thing we have noticed, now this essentially tells us the most popular stocks across all super investors, and one thing we note here is that Google, ticker symbol GOOGL, has around 30 super investors that hold this in their portfolio. But one thing you will notice is that GOOG, which is still Alphabet, just a different voting share right, has around 26 super investors holding this position in their overall portfolio. So when we add them together, we get 56, meaning that Alphabet, in combination of both tickers, does actually sit above Microsoft at 33, meaning the most held stock by super investors right now is Google. Now, the other thing we want to point out is that over the last 2 quarters, in terms of super investors movements, is that actually Alphabet, as we can see here, has been bought by 11 different super investors over those 2 quarters. We also notice the other ticker symbol here with 8 buys, meaning 8 plus the 11, we get to 19, making it the second most bought stock by the super investors over the last 2 quarters, second to just Microsoft Corporation. Now, what's very important to understand before we do our deep dive analysis is that the largest portion of their revenue stream does come from Google search advertising, which is 54 billion of their total revenue at 97, meaning it makes up more than 50%. But what we will have to say before kicking off with some of the issues is that it is up 13%, double digit on a year-on-year comparative. The other thing that we do want to point out is when we look at the beginning of this year in terms of what consumers are looking at, whether that is through broadcast TV, streaming or cable, the number one here is YouTube, which is 10.8%. And as we saw, it is one of Google's revenue streams overall, one that has been increasing as we take a look at 14% year-on-year in just the most recent quarter. Now, one article that we do keep coming to is this one here, which was released at the end of November last year. And why we typically like to start off with this, not because they say Googling is for old people, but they really drill down into one of the issues that investors are seeing with the company. And we need to understand, is this in fact under siege in terms of their largest revenue stream, or is this one that actually over time they will be able to strengthen and not look at this in terms of a negative light? Now, very briefly, as we have highlighted this article in a previous episode, but what this is trying to say is that Google, similar to the Titanic, is looking very strong, looking unsinkable, but there is a force of nature, which in this case is LLM models, something like ChatGPT, as well as DeepSeek, and in fact Grok, that is looking to take away their market share, and that is something we also want to touch upon very soon. What we need to understand as investors is, do we believe that people are increasingly moving away from Google search and moving towards artificial intelligence? Now, this article really tries to drill home that younger generations are doing exactly that, and therefore if they are doing this, the advertising revenue that Google will be trying to bring in, their number one income stream, will start to deteriorate over time as advertisers move away, given the target audience, which is supposedly only going to get smaller and smaller. And this is effectively wrapped up in this paragraph where they say the first danger for Google is clear and present. When people want to search for information, they typically look at Google's competitors, and that would affect affect their advertising dollars, their bottom line as well, and we get here projected in 2025 for the first time in quite some time. Google's advertising revenue will fall below 50%, which is fairly significant as it hasn't been below that for the first time since the company did start to track it. Now, we are also going to cover some of the antitrust issues, and all this implies is that we do need to consider a larger margin of safety when we get to our own valuation model. And we can see here the second threat is the rise of answer engines like Perplexity, and one thing they really want to point out, it isn't just ChatGPT, but Meta platforms are also looking into this, as well as Microsoft and Apple, and the bottom line from all of this information that we have consumed is that Alphabet's number one income stream, their search advertising, is under a large threat, and this is why the company, as we will come to show you, does trade at an incredibly low valuation. So what are they looking in terms of their earnings moving forwards? They're anticipating over the next 4 quarters to be growth on a year-on-year comparative, with over the last 4, they have outperformed management targets 100% track record, meaning based on the $9 earnings per share for the full year of 2025, the company now trades at a valuation of 18.95, which does look incredibly low, and we're going to discuss that very soon. But one thing we want to remind you is why this company did fall, at least after their earnings, and it wasn't just the revenue miss they had, but they did announce a large artificial investment which was significantly higher than what the overall market wanted to see, and that is something we are going to discuss and compare against others in the Mag 7. Now, before we do just that, we want to pinpoint that their top line numbers weren't too bad. Revenue 96.47 was slightly below the 96.56 forecasted, but their EPS, as we just saw, on a consistent basis did outperform 215 versus 213. Now, in terms of the other metrics that Wall Street does like to look at, they did outperform on YouTube revenue advertising, 10.47 above 10.23. We did just take a look, it has been growing around 14% year on year. Their cloud revenue did come in under 11.96, below 12.19, and so did their traffic acquisition costs, 14.89, below 15.01. Now, their overall revenue is still up 12% year on year, which isn't too bad for a supposable dying company. However, as pointed out in this paragraph here, every single metric is slightly lower than a year ago. Advertising revenue growth 10.6 in comparison to 11, search revenue 12.5 in comparison to 12.7, even YouTube ads revenue 13.8 below 15.5, and the company's service business 10.2. What we saw a year ago was higher at 12.4. As we said, the main reason this company did fall after their earnings, they announced they were going to invest $75 billion into capital expenditures to expand on their AI strategy, and Wall Street were expecting a significantly lower amount at $58.84 billion. We also got to see their bottom line net income, which was up, as we note, 28%, $26.54 billion, same quarter last year, sitting at 20.69. Now, we just want to compare that to others in the Mag 7, given one of the issues we did have for this company was their high capex spending. Now, Meta, when they released their AI capex spending, they said they are looking to spend around $60 billion. In fact, it may go up to 65 as they do look to increase their AI infrastructure. We then got Microsoft, who just a few days ago reiterated their plans to invest around $80 billion. That is higher than what we just saw from Alphabet. And then we end on Amazon, who said they plan to spend $100 billion this year in what they call a once-in-a-lifetime opportunity to capture everything that's going on with AI. These are some things that we do want to throw into the mix, as we do need to understand quite a lot about the company, as it is going through a very significant downtrend, and it could be argued an incredible opportunity, but on the other hand, it could also be seen as a massive risk. Now, they get an F on the valuation, not one we agree with, because the sector, which does sit lower at 13.2, doesn't compromise of high quality companies like Alphabet and their metrics. Again, we will highlight that you are paying 44% premium above the sector, above the group that this company has been put in. In terms of their own 5-year average at 25, Alphabet now sits 25% lower, and that is something that is very consistent no matter what valuation metric you look at today. Alphabet trades quite some way above the sector, but quite some way below their own 5-year numbers. In terms of growth, they get a B. Now, year on year, 14% growth. Over the next 12 months, anticipated 12, well above the sector at the low single digit. So, of course, it does deserve a premium. but over the last 5 years, they have grown at a more substantial rate, 18 and 15% respectively. We then look at the EPS growth over the next 3 to 5 years, expected to be around 17%, when we can see the sector is low at 12, and their own 5-year only sits marginally above at 17.92. In terms of the profitability, they get a strong A+, gross margin 58%, well above the sector at 52%, above their own 5-year at 56%, bottom line 29%, again above the sector at 4%, above their own 5-year at 24%, which is telling us this company not only increasing their revenue over time, but they're improving on their margins. We love to see efficiencies in companies, and on top of that, they are generating a significant amount of cash from operations, 125 billion. We can see the sector comparative at 325, their own 5-year at 86 billion. This is one of the most, if not in the top 2, in terms of cash generated from the Mag 7 overall. Now, one bearish case that people put forward for this company is that they are losing their search engine market share, and one thing we wanted to highlight is what the data shows on an updated basis. And if you go back to essentially January 2009, we're talking nearly 16 years ago, this company held around 90.25 of the overall market space. And then when we zoom forward to the most recent data point, we have February of this year, it sits at 90.15. So yes, whilst there may be some fluctuations over the years, right now it is still sitting above 90% and not that far off where it's at in 2009. If we compare it to others, we have Bing at 3.95%, Yandex at 2.3%, and Yahoo at 1.3%. There is a very clear winner, and this is one that has been, as we can see from the data, number one, very significant margin for quite some time. One famous CNBC analyst, Jim Cramer, has actually gone on the record to say that he has started selling his Alphabet shares. He believes that right now this is the Mag 7 company to sell and in fact not to buy or hold, and we just bring it to your attention as a lot of investors do like to follow what he's doing. But as always, you should do your own due diligence and never buy or sell based on institutions, investors, or anyone but yourself and your own research. And we also get at the beginning of this year, we have a few analysts who actually say that Alphabet is not a buy right now, and they say the punishment will be very severe, although what this article is relating to in specific is some of the issues the company has faced following the antitrust decision, and this analyst doesn't believe this is one we should now be risking. The risk reward just doesn't look sufficient. Now, in previous episodes, we've covered the worth of the company in terms of a breakup, and many analysts have got to a price of well over $200. But as we can see, it was November last year where the Department of Justice did push for Google to break off their Chrome browser, but nothing is yet for certain. And then we also understand at the beginning of this year, the UK also had a probe for Google for the exact same reasons under some new antitrust rules. It doesn't stop there, as China also launched a probe into Google about the same violations, so it doesn't seem to be the easiest time to be a Google shareholder. And something in a more humorous tone that we can see here is that Russia did fine Google more than the world's entire GDP for blocking Russian media outlets. Now, whilst this is not as serious as the others, it does drive home the point that right now this company is facing some difficulties, and if we just compare them against others in the interactive media space, Meta Platforms, Tencent Holdings, as well as some others, over the last year, it is still up 25%. Over the last 5 years, it is up 155, the second best performing, next to Meta. And over the last 10 years, it is up just under 500%. Again, the second best performing, but as always, past performance is not an indication of the future. We also just want to highlight they have outperformed the S&P over the last year. They've outperformed over the last 5 and over the last 10, even after the drop we have seen, at least in the shorter term. But as always, these are just some considerations to have. And when we look at what the institutions are doing, they hold around 40% ownership. They've sold around 50 billion over the last 12 months in 2024, but they have bought a significant amount more of 86 billion during the same time frame. And we also notice in Q4, the most recent period, they bought twice as much as they have sold. So clearly institutions, at least over the last year, have been very bullish on the company. And we can see around 12% insider ownership, 118 million worth of sales. In the most recent quarter, 14 million. Now, we do like to show this, but as a reminder, we don't see this as a bearish signal. They sell for many reasons, personal and financial. And the largest sum we do get here by an insider on the 21st, so around a week ago, selling just under 18,000 shares. netting them $3.3 million. Again, information is there if you do want to use it. Now, we also want to highlight the quality of this company, some of their underlying metrics. They do in fact pay a dividend, so they get a safety score of 80, meaning a dividend cut for the company is unlikely. And then we want to move on to our first valuation model, although do bear in mind we're not looking at this in isolation. We will conclude when we run it through our own DCF. The blue tunnel is the expected fair price. Nice to note, it has been increasing over the longer term. Ultimately, you do want companies you invest in to be worth more and more as time progresses. Right now, though, it sits outside even the lower end of the blue tunnel, indicating severe undervaluation. In terms of the forward P as well, we do note right now it sits below the 5-year. Again, another signal for what we would say is undervaluation, and definitely one to further investigate. Now, free cash flow, always look at these metrics over the earnings, which is susceptible to manipulation by management through accounting. Below 60% can sit around 14%, meaning we should be expecting some nice dividend increases from the company. And then we get to the free cash flow. We want to see consistent growth over the longer term, and that is pretty much what we get. Very good growth, and in fact, over the next 12 months, it is expected to continue the upwards trajectory to $6.20 of free cash flow per share. And in terms of sales growth, we get nearly double digit every single year, bar 2023, the most recent year sitting at 14%. And from a numerical perspective, we can see the growth. But one thing to highlight is this company has been returning excess cash to investor pockets. They've been doing share buybacks pretty much consistently from 2018, and maybe we will see them do it on a more aggressive basis given how cheap this company is, or at least how cheap it looks in comparison to its intrinsic value. In terms of ROIC, as always, one of our favorite metrics, we want 10% or more to give us faith management are able to effectively allocate their capital. We can see it's been growing over the last 10 years, now sitting at 32%, very strong. And why this is important, because when they are spending a very large sum on essentially CapEx for AI, we also want to see a high return on that money. In terms of operating margin, as we highlighted earlier, looking very strong, not only above the minimum 12%, but we get efficiencies, meaning increases over time. And the same to be said about the free cash flow, looking very good, well above the 5% minimum, and in fact, a very consistent free cash flow machine. Net debt to EBITDA, we want below 3. Now, this does highlight the strength of the balance sheet. These are the number of years it would take Alphabet to pay off all of their debt net of cash on hand. 0 right across the board and expected over the next year, meaning a phenomenal balance sheet. Won't even take them 1 day to pay it all off. Then we want to highlight something we haven't touched upon yet, not their revenue, because we've already seen how strong and consistent this has been over the last 10 years, but we want to flag what does their bottom line net income tell us, what is the story to be told, and for the large part, very consistent growth over the longer term, going from 16.4 billion 10 years ago to now sitting at 100 billion in the most recent annual accounts. That is some very impressive growth. Now, we've already talked about the health of the company, but we want to do it in terms of highlighting to you exactly how strong. Total cash versus total debt. Cash has been increasing over the period, going from 72 billion to 96 billion. That is a very large sum. But as always, one number here in pure isolation isn't going to give anything away. So we compare it to their total debt numerically and directionally, and whilst it has been increasing over the longer term, going from 7.7 billion to now 28, we just saw minutes ago cash was far superior than this, and therefore, as highlighted, it won't take the company 1 day to pay off all of their debt net of cash on hand. We also want to highlight the company's cash they generate from operations has only been increasing over the period, going from 27 billion in 2015 to now sitting at 126 billion. Now, just before we jump into our valuation model, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning, completely free to your inbox, where we cover severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up, as well as grabbing a copy of undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. We then jump into our valuation model, where we get an intrinsic price of $226 derived from the DCF model. Now, we'll show you here, we have the free cash flow year on year updated for their 2024 earnings. Now, average growth 20% on a year on year perspective. In terms of moving forwards, we have gone 12%, but as you can see, a low, medium and high, Numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others. But based on 12% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 226 indicating 33% upside. Now, full transparency, we'll show you at the 10% point, intrinsically 197, upside of 16%. And for those that believe it should be a lot higher, a lot more optimistic, at 14%, 259, indicating 52%. Now, we like to take through the median rate today at 12%, where we're not just done there because we like to add a margin of safety. 10% execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $203, then we keep going till it's near the current trading price. And what we're effectively saying is right now, Mag 7 company trading very low in terms of its own 5-year average, and in comparison to the rest of the market, you're getting a 25% MOS. Wall Street themselves see upside of 29%. They see this company at $220 over the next year. Now, what we also want to do, for those that actually believe 12% is too high, we're going to go through 10% and show the margin of safety today. So at 10%, a buy up to 177. At 15%, pretty much not too far off. So if you do believe the growth rate should be lower, instead of the 25% that we did see earlier, you're getting, for a 10% growth rate moving forwards, 15% MOS, near enough. And as we can see, Wall Street's price target still remains the same. But as always, give us your thoughts. Right now, Alphabet, do you see this as a buy, a hold, or a sell? Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon, where we do cover our weekly buys and sells. And we have been buying, given the volatility. But as always, have a great day, and we'll see you all on the next one.